Here's a number your bank doesn't want you to know. $306 billion. That's how much in unrealized losses U.S. banks are currently sitting on as of their most recent filings.
Trillions of dollars of commercial property loans are coming due in the next few years. It's causing some pretty big concerns in the financial sector.
Maturing commercial real estate debt is set to peak at nearly $1.3 trillion in 2027, according to S&P Global. And the industry is facing a refinancing reality check with interest rates still well above pre-pandemic levels.
Another number, 60 banks are on the FDIC's confidential problem list. And a third, $900 billion in commercial real estate debt, is maturing in 2026 alone, with office loan delinquency rates exceeding 12%. These aren't conspiracy numbers. These are from the FDIC, the Federal Reserve, and MSCI. They're published, they're public. But nobody on your evening news is connecting the dots for you. Because when you connect them, the picture that emerges is a banking system that has been quietly playing a game of hide the losses for 3 years, and the clock is running out. Today, we're breaking down the $3.1 trillion real estate crisis that's sitting on bank balance sheets across America. We're covering 3 things. Number 1, the extend and pretend strategy banks have used to delay the reckoning, and why it's collapsing. Number 2, why regional banks are 5 times more exposed than the big guys and what that means for your deposits in your neighborhood. And number 3, the specific trigger that could turn this slow-motion crisis into an acute one. What we cover in Section 2 is the part that should concern every American with money in a community bank. Stay for it. If you're watching this channel for the first time, subscribe and hit that bell. We break down the financial data they don't put on the front page every single week. Let's go. First, the debt wall, because this is the foundation of everything. During the mid-2000s, when interest rates were near zero, banks lent aggressively to commercial real estate developers and investors, office towers, apartment complexes, retail centers, shopping malls. The loans were written at 3 to 4% interest with 5 to 10-year terms, and everyone assumed that when those terms expired, rates would still be low, property values would be higher, and refinancing would be seamless. None of that happened. According to the Mortgage Bankers Association, $875 billion in commercial and multifamily loans are scheduled to mature in 2026 alone, a 9% decrease from 2025's peak, but still a historically massive volume. Other estimates are higher. Some put total CRE maturities through end of 2026 at $1.8 trillion according to TREP. And when you add in the residential mortgage-backed securities sitting on bank balance sheets at marked-down values, the total real estate exposure across the U.S. banking system exceeds $3.1 trillion. The problem isn't just the volume, it's the math. The average interest rate on new CRE loans issued in 2025 was 6.24%, compared to 4.76% on the maturing debt. That's a 31% increase in debt service costs just to roll over the same loan on the same building. And many of those buildings are worth 30 to 50% less than when the original loans were written, because office vacancy rates are near 18.2% nationally, and rent collections have cratered in distressed properties. So what have banks done about it? They've played a game the industry calls extend and pretend. And this is the part they're hiding from you. Here's how it works. A commercial loan matures. The borrower can't refinance because the property is worth less than the loan balance, or the new rate makes the monthly payment unserviceable. In a normal world, the bank would classify this as a default, take a loss, and either foreclose or restructure. But that would force the bank to mark the loss on its books, which would reduce its capital ratios, trigger regulatory scrutiny, and potentially require it to raise money or cut lending. So instead, the bank modifies the loan, extends the term, adjusts the rate slightly, kicks the maturity out another 2 or 3 years. On paper, the loan stays performing. The loss never gets recognized. The bank's balance sheet looks clean, and the problem disappears until the extension expires and the borrower still can't pay. According to data cited by Reuters, 41% of commercial loans that matured in 2023 were modified or extended rather than repaid or refinanced. And many of those extended loans are now coming due again in 2026. But this time, some banks are beginning to quietly dump real estate loans rather than extend them further, indicating the strategy is running out of road. And here's what makes this particularly dangerous. Upcoming changes to loan disclosure rules will allow modified loans to fall off bank reporting requirements after just 1 year. That means some of the riskiest, most extended loans in the banking system could simply disappear from public view, making it harder for regulators, investors, and depositors to assess the true health of their bank. The losses don't vanish, they just become invisible. Folks, if this is the kind of data that changes how you think about your money, share this video and subscribe. We track these banking and real estate numbers every single week while the mainstream financial media glosses over them. Now let's talk about who's actually exposed, because this is not evenly distributed. According to Goldman Sachs, regional and community banks account for roughly 80% of all commercial real estate loans held by U.S. banks. 80%. JP Morgan's own research shows that small banks hold 4.4 times more CRE exposure than their larger peers. CRE loans make up 28.7% of assets at small banks, compared to just 6.5% at the big banks. And another analysis found CRE holdings represent 44% of regional bank balance sheets versus just 13% for large banks. What does this mean in plain English? It means your local community bank, the one where you have your checking account, your savings, maybe your small business line of credit, is likely 4 to 5 times more exposed to commercial real estate losses than Chase or Bank of America. And if enough of those commercial loans go bad at the same time, it could potentially lead to their collapse, according to Fitch Ratings. New loan-level research finds that latent distress, loans that would be underwater at today's property values, is approximately 4 times larger than what current delinquency rates imply. 4 times. That means the actual scope of the problem is being hidden by the extend and pretend strategy. Banks are reporting delinquency rates of 1 to 2% on their CRE portfolios, but the real exposure, if they mark these loans to market today, could be 4 to 8%. And this isn't just about commercial real estate. The same regional banks are facing headwinds on consumer lending, auto delinquencies are back above pre-pandemic levels, credit card charge-off rates are elevated, and total household debt has hit $18.8 trillion. These pressures are all converging on the same balance sheets at the same time. We already have a preview of what happens when it breaks. In January 2026, Chicago's Metropolitan Capital Bank and Trust failed, costing the Deposit Insurance Fund $19.7 million. It was small, it was quiet, it barely made the news, but it's a signal. And the FDIC's own quarterly report warns that weakness in certain loan portfolios, particularly office properties, continues to warrant close monitoring. Now, the specific trigger that could accelerate this: the special servicing rate for office CMBS loans has climbed to 15.8%, meaning nearly 1 in 6 office loans is now being handled by a workout specialist rather than the original servicer. Close to $25 billion in CMBS loans are now past maturity without repayment, liquidation, or formal extension, levels not seen since the post-2008 recession cleanup. And 60% of the most distressed apartment loans come due in the second half of 2026. The trigger isn't one event, it's a cascading series of events. Loan matures, borrower can't refinance, bank can't extend again. Property sells at distressed prices. Loss gets recognized. Banks' capital ratios weaken. Regulators step in. Lending tightens. Credit dries up. Local businesses that depend on that bank's lending lose their lifeline. Property values in the area drop further. More loans go bad. Repeat. That cycle is how regional banking crises work. It's how the S&L crisis worked. It's how 2008 worked in slow motion at hundreds of community banks. And the conditions for it are present right now. Concentrated CRE exposure, unrealized losses, extend and pretend exhaustion, and a real estate market that is posting its weakest price appreciation since 2012. So what do? If you have deposits at a community or regional bank, check your bank's CRE exposure. FAU's Banking Initiative publishes a free screener ranking 154 of the largest banks by their real estate risk. If your bank has CRE concentration above 300% of Tier 1 capital, you should understand what that means for your money. FDIC insurance covers $250,000 per depositor per bank. If you're above that threshold, spread your deposits. If you're a real estate investor, understand that credit is going to tighten further in 2026, especially from regional lenders. Banks that are nursing CRE losses are not going to be aggressive on new lending. Have your financing lined up before you need it. If you're a homeowner, know that your local economy is partially dependent on the health of your local bank. When a community bank fails or pulls back on lending, local businesses lose credit lines, construction projects stall, jobs get cut, and property values feel the downstream effect. Here's the bottom line. The banking system isn't about to collapse overnight. Capital levels are stronger than 2008. Lending standards have been tighter, and the FDIC's insurance fund is in better shape. But $306 billion in unrealized losses, 60 banks on the problem list, $900 billion in CRE debt maturing this year, and an extend and pretend strategy that's running out of road, that's not a system that's fine. That's a system that's managing a crisis in slow motion and hoping you don't notice. Now you notice. Subscribe, hit the bell, and drop a comment telling us, do you bank with a regional or community bank? Have you checked their CRE exposure? Those conversations help everyone in this community see what's really at stake. See you in the next one.